Welcome to Life Planning 101, brought to you by Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101. This is Matt Ervin and Aaron Kennedy right here on Black and White Market Chatter on Life Planning 101. We have another great episode for you today rolling out. Topic is inflation. The Fed had a meeting and they gave us a little bit of insight, but not much. Aaron, why don't you give us your initial thoughts on that?
It's a lot of the same that they've been talking about. Number one, they're going to do something. And he's playing hardball now, and he's put the date on it that interest rates are going to start up sometime in March. And he's already told us that he's going to do 3 different interest rate hikes throughout the year. So the biggest question is, does he stick to the 3? Does he go 4? Does he go 5? But overall, they're looking to raise somewhere around 75 or 0.75% this year. And by 2024, I believe it should get up to somewhere around 2.5 to 3%. And that's going off of the Fed pages and what their expectations are over the next several years.
And it's interesting, right? Because they haven't come out with anything definitive. They won't say anything, but to kind of paint the picture of where we're at, this was a little shocking to me even. They said the last time we're at a 40-year high for inflation, right? And the last time that it was this high, the Fed funds rate was somewhere around 14%, and debt was around $850 billion. And right now, the Fed funds is right at 0% with right at $30 trillion of debt. So it's quite a different situation. So
if we had a Volcker-like Fed chief come in and try to do the same thing as he did in the 80s, and they just raised interest rates until inflation goes away, that would set our interest rate payments somewhere around $4.2 trillion. It's unachievable. That would dang near bankrupt our country.
Right.
That would not be good. I think our interest rate payment right now is $420 billion or something like that, which is still an obscene number.
Right.
And that's at zero interest.
That's at zero interest. And you said that what if we doubled that? It would be about 3.3% on the Fed funds rate. It would get our interest rate payment to right at about $1 trillion.
Yes.
So it doesn't take a whole lot to get there. With the dot plot saying about 2.5 long-term consensus, we got to have pretty steady clips to get there. But that's interesting.
Over such a long period. I think we were talking earlier is who in the heck knows what's going to happen in 2023 or 2024. So the dot plots are fun because we're just trying to guess out into the future what's going to happen in the market. Also try to guess what happened in Ukraine, and there's lots that can happen over that time period.
Well, it's like the guessers get to watch the best guessers, right?
Yes.
So it's like a second level guessing. But one other thing to note is the amount of assets on the balance sheet, right? One of the things he said was he's going to rapidly reduce that down. And I found it extremely interesting that there's 30% of the outstanding Treasury notes and bonds are on the Fed's balance sheet. And that can equate to about 1 to 2 extra rate hikes over 2 years. So it's not only what they do to raise the rate, it's also how quick they shrink that balance sheet. It's kind of coming from both ends.
Right. Well, think about this. So over the last 2 years, we printed, $8 trillion, somewhere around in there. Do you remember what the actual economic output was that first quarter of COVID? Didn't it drop like 30%?
Yeah, right there.
So our GDP dropped 30%. So what do you think is going to happen if we suck $9 trillion out of the economy? We put $8 trillion in and it kept us from going down 30, and we've had good economic growth, but it took $8 trillion. What happens if we pull $9 trillion out?
Right. Well, and what did you tell me earlier? So the
Grab
Fed,
your hat, cowboy. Here we go.
the Fed holds a third. The American people hold a third, and then internationally they hold a third. And we're so worried about what they do. What if they sell the American dollar?
Yeah,
and
I've been hearing for decades now. China's going to take over the world, and they can implode the United States by selling all their U.S. assets or their government bonds. They're going to crater the U.S. dollar. That's not the biggest fear. Our biggest fear is, what if the Fed does it?
What if we do it to
What if
ourselves?
we do it at home? It's the same concept.
Yeah.
But that's what the Fed tells us they're going to do. They're going to get that off the balance sheet, $9 trillion. Whoa.
Yeah, that's pretty wild to think about. So let's take this opportunity to take our first break right here on Black and White Market Chatter Life Planning 101. We'll be right back with you. And we're back here on Black and White Market Chatter on Life Planning 101. Matt Ervin, Aaron Kennedy, talking about the Fed and what they're going to do with interest rates and kind of trying to wrap our head around what they do and what that'll do to us. So right now we're paying $424 billion in interest. If they go up, that goes up. And we're a little bit nervous about the amount of interest they could pay.
Yes. So if we get to what the dot plots show, or what the Fed governors are believing is going to happen, interest rates are $1 trillion, and that's almost 15% of our budget. Right now it's almost exactly half of that, but still 15% is due to overspending over the last 3 to 4 decades. So
when you think about budgets, right? We talk a lot, and we've talked historically about how much the defense budget is versus these interest rate payments and how much interest we're actually paying. And so I've not heard of anybody talk about shrinking a government budget, right? They always have to say, I need to spend all of my budget to make sure I get that money next year. And so if interest rates go way up, and we can't support that, I mean, our income only goes up so quickly as far as income taxation. So there's some downward pressure from politically, right, to keep that interest rate low. But yet, if we don't do anything, we're going to run too hot. So kind of tell me, what tightrope is he walking right now?
That's a great question. The Fed only has a couple of tools to stop inflation or cool it down. And any of the tools that they're going to use are designed to slow down the economy. Anytime we've run hot from an inflation standpoint, government raises interest rates. I mean, that's been the traditional tool. Well, right now, I don't think our economy can handle if we try to slow it down. I mean, we're just coming out of COVID. Just walk around town, wherever you're at, you're going to see help wanted signs everywhere. The economy's not running at full capacity now. So if we do everything that we can to shut it down to stop inflation, that's going to be painful. I was talking the other night, and I was just asking people, would you rather have 7% inflation, or would you rather have your portfolio drop by 30 to 50%? Because the Fed did their job with inflation, but it cratered the market and sent us into a recession. That's the tightrope that he's having to walk.
Right.
So is it even worth it? And 7%, yeah, that's painful. But some of the stuff that's really driving it, think cars. As a collective population, we're buying used cars all the time. But for a family, that's a one-time deal every 3 to 5 years. Same thing with a house. They're one time. So if we look at our inflation basket, from an individual level, it is probably closer to that 6 to 7% long term. But as long as we can continue to grow the economy and grow your assets greater than that, we stay ahead. If we can grow your assets at 7.01% when inflation's 7, hey, you're okay.
You're not losing the buying power.
You're not losing the buying power. If we lower inflation to 2, but we just dropped your buying power by 30 to 50%, that's different. And look back in time, how often has the Fed got it right?
Well, what about 2018? We talked about that, and that was a quick market up and down.
We tried this before.
Yeah. Well, we got to look at history. I know there's some folks out there that hate to look backwards, tearing statues down and whatnot. I know that's a whole nother subject, but we need to review history to make sure we don't repeat history.
Yeah, we tried to stop the QE in the past, and it blew up a repo market. And repo market is the market between our banks and our federal government. It's the way for them to get money on and off the balance sheet very, very quickly. But you go look at the repo market during 2018, that interest rate was, what was it, 14%? Something ridiculous. And when interest rates are close to zero and you look at the repo markets at 14, that's broken.
Yes.
We've never seen a reversal of the Fed that quickly. It's like, oh no, the banking system's fixing to go down. We better start buying back our Fed funds. So, not our Fed funds, but our debt, the QE. So we've tried it. It didn't work. We weren't on sound enough footing then in 2018. Where are we at now?
Right. Historically looking, it looks like 2018, it felt much stronger than it does now. It feels like we're, the indicators and the economic output says we're strong, but it feels like we're like an eggshell. There's some strong eggshells out there, but they're in general pretty fragile.
Yes, yeah. And a lot of the economic stuff we're looking at year over year, and we're looking at a point in time where everything seems broken. Our supply lines, employment, amount of money that's in the system, nothing's working right. So by looking at all these forward-looking indicators, you really got to dig down and know what you're looking at and not just take it at face value.
Right. Well, and it's easy to say, people are getting back to work when nobody was working, and we're still got a lot of people on unemployment. I know they've shaved those unemployment benefits and people are looking for jobs, but we're not. It says we're fully staffed. We're not fully staffed. How is it?
3.6% unemployment.
Right.
So that means our economy is running, it's overheated. Back in the early 2000s, 5% was full employment.
Right.
Full employment. We're 20% over capacity if we look at the numbers right now. Yet, if you go to McDonald's, you're going to stand in line for 45 minutes because there's only one person back there making the burgers.
Well,
tell me how that's working.
And then go to a big chain grocery store.
Yeah.
And you see 2 lanes out of 15 open and the self-checkout is full.
Sorry, McDonald's, I'm not picking on you. I'm just overall.
Right.
But to Matt's point, it's across the economy. Truckers. There's not enough people moving stuff across our country. Anywhere you look, we're needing workers and we can't get them, but we're fully employed.
Right. It's a facade, right? It's a facade. There's not enough meat and potatoes behind it. But hey, Aaron, let's take a quick break right here, and we're going to come back with some other great information for you on black and white market chatter on Life Planning 101. And we're back here on Black and White Market Chatter on Life Planning 101. Matt Ervin, Aaron Kennedy. We're wrapping up our perception of the Fed and kind of what we're going to do, how we're going to be patient and listen, and some of the things that are going to keep reactions down. For instance, we talked earlier about political reactions. We got midterms coming up, right? Midterm elections. And so we know that they're trying to get legislation through, and Powell is forced with how quick he's going to raise rates, and all that's correlating. And so we see some legislation about, what was it, Biden's big bill has busted a couple of times, right, coming through. And there's one piece of that is the child tax credit they're trying to get, but and minimum wage. So they're enhancing those things. But again, we just talked about our unemployment, right, and then how we're really not fully staffed, but yet we're going to pay people to continue to stay home.
It doesn't make any sense. We keep saying this, but we're running a tightrope. We got to figure out a way to get people back to work. We need to slow down or stop the support that we're giving people that's not working. We got to get our economy on firm footing, and the way to do that is let the economy run. As painful as it is, because more than likely the government's not going to keep up with inflation anyway. So if you're getting money from the government not to work, are they increasing your checks 7 to 9% a year? I don't even, what was Social Security, 5.9?
Yeah, it had a big jump this year. It
right.
did.
Biggest in a long time.
Right, biggest in a long time. But how many years did the grocery bill go up? And then they said, no, there's really no inflation. So
yeah,
it doesn't happen.
Hasn't kept up. We got to get the economy on a firm footing. And the easiest way to do that is run hot. I think we've talked about this before, but the Fed's hands are tied. There's not a lot they can do. They're going to bankrupt our country by increasing interest rates too much. You talked on the midterm elections. If the economy drops or the market drops 30 to 50% before November, they don't stand a chance. This is going to be more political, and they're going to slow roll it. And I really think Powell, after this first initial boost of interest rates, hopefully only in 2022, he's going to need to find a reason not to raise it anymore. So when we're looking at what the Fed governors are thinking for 2023 and 2024, I don't think it matters. After 2022, if we're up another percent, we got to stop there, because we can't afford the interest payment. We can't afford the economy dropping out the bottom. We got to get people back to work. There's too many things out there that are going to be hurt if we shut her down.
Yeah. Well, we talked an earlier episode, and I've always liked this example. We talked about feathering, right? The government has to feather that somewhere between, are we getting too hot? Maybe I need to cool it down just a skosh, or talking about cooling it down. The market reacts, and then it kind of gets back on its foot. But Powell's kind of in a corner where he has to do something, right?
Yeah,
We're there.
He has to do something. Trust the government. Trust the government. They're here to help. So he's got to have a plan. He's got to do something. So let him do something, but keep him from doing anything else after this year.
Well, and in this case, I believe that'll happen. Right? He can't get too carried away because the political pressures. He can't get too carried away because the market pressures. Right? He needs to make a step, do his job. Right? But
and imagine how much of a problem, not really a problem, a puzzle he has, because he's looking at today. Where's inflation at today? What do we need to do today? These are all things. And I think, more than likely, we like to laugh that the Fed's never got it right, and they've always, they've gone too far, but they don't look far enough in the future, or they can't predict what's going to happen in the future. So, it's very difficult to get it right. So I'd rather him err on the side of caution.
Yeah.
It's so slow. Feather
it, right? And so we listen to many podcasts and articles and read periodicals, and there was something we talked about the other day: the habits of a country that has currency debasement, right? And of course, Venezuela comes up, and they were getting paid, I think, 3 or 4 times a day. They'd have to all run to the store, buy what they could, buy too much, because then they can sell it to their neighbor at an inflated price when they get off of work. And but the truth behind it was, society's turned into a very gambling society. It's all about buying something and selling it for more. It doesn't matter what it is: bread, cars, goods, services, whatever you can get, and then get it to somebody else for a higher price, right? Yeah. And when we kind of reflect on that to the Americas right now, what are we seeing?
Yeah, we saw that. It's an absence of hope, that you can get ahead. So the population starts to gamble more and more. And we all heard what happened with GameStop, AMC, go look at Reddit. These people were gambling like crazy. Yep. The Vegas shut down, so where did they go? To the markets. And it was incredible, because at that point we had retail investors driving the market, shutting down some big institutional investors, Citadel. These are big, big companies, and it had to get before Congress to stop it.
Right.
The little man raised his hand and destroyed a lot of what was going on. And that is that gambling mentality of, I don't have any hope, and I've got to get ahead one way or another. So YOLO, let's do it.
Let's roll. Yeah, and it's kind of, this, you think about it, so it's kind of like a protest, right? Protest against the man. We've seen different protests in our country over even the last couple of years, different things. But that's, again, it's like a protest. If you read the boards there, everybody, hold in there, don't quit, don't give up, stand together, but they were moving the market, and they were doing it together, right? People were putting their mortgage payment on black and gambling away. And some did very well and some didn't. But it's going back to that society of gambling. So, Aaron, we're trying to get wrapped up here, but I want to talk about, we always try to circle it back to what we're doing. So we're trying to build some dry powder, right? It's always good in times of volatility to have that dry powder.
Yes.
So tell us, we're sitting kind of being patient, right?
We're trying to be as patient as we can right now on most of our fixed income or our bonds. We've got super short, and we're in a lot of inflation protected securities, which means they go up in value with inflation. So we're trying to hold out there to kind of see what happens. A lot of portfolios, we've added some upside protection as well. So if the market takes off, we still get the majority of that, but we're sitting, close to 40% on the sidelines, just waiting for that opportunity. Yeah. And right now it feels like the opportunity is going to be the market going down. So we're being really cautious right now, and we're trying to get some risk off the table. Most of the growth companies, the big, super expensive growth companies, we've got rid of those. We're trying to get out of small caps for a whole lot. We're trying to build into our value factor or dividend aristocrats, some of the safer, more consciously run companies that have done a good job with their capital over long periods of time that produce things. We keep saying that we want to be buying things. We're buying companies that produce things, yeah. And we're still there, and that's the path we're trying to take. So we've seen this before. We've seen it lots of times, and there's ways. There was things to do in bad times that made money, and that's really our playbook. So we're trying to do what's right and what's worked in the past in these types of scenarios.
Being patient, but being active where we need to.
Yes.
That's the biggest thing. So, that's great, Aaron. I hate to cut it short, but we do have to go. Black and white market chatter. Aaron Kennedy here at Kennedy Financial Services, Matt Ervin. We're wrapping up our latest episode on Life Planning 101.
Thank you. God bless.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.